A massive protest over frozen bank deposits turned violent in China.
The next in line could be Chinese banks, because China's banking sector remains vulnerable.
Analysts caution on margins, that margins will be hard for the Chinese banks to keep up this year.
Millions of homes could be taken down in the coming weeks. The crisis within China's property sector is getting worse.
They have a $550 billion hole.
Welcome back to Serious Coinage. The Chinese economy has been through a tumultuous period owing to the pandemic. But how much of an impact did COVID really have? In this video, we're going to take a look at the current state of China's economy and the measures being taken to help it progress out of its current struggles. While we still don't know what long-term effects the pandemic will have on global economies, I can tell you that for China, things aren't looking great right now. From GDP growth to unemployment rates, there are multiple aspects that need to be addressed and carefully analyzed if the Chinese government wants their economy to bounce back. So, today we'll look at multiple data and statistic references. I'm going to provide an in-depth look into China's current economic situation and discuss what measures are being taken to help it recover. Is the golden era of China over? The US and other Western nations have begun to disconnect or de-risk in their economic ties with China as a result of the assertive foreign policy that Chinese President Xi Jinping has imposed. Close ties with Moscow, threat to invade Taiwan, neutral approach on Russia's invasion on Ukraine, which means that a crucial component that had previously underpinned China's rapid growth is decreasing. Trade disputes between Beijing and Washington from the Trump administration have continued under US President Joe Biden. US sanctions against several Chinese companies and officials followed tit-for-tat tariffs on the basis of national security. Washington has even limited China's access to its semiconductor and artificial AI technologies. Moreover, the world's second largest economy is struggling after China abandoned its 3-year zero-COVID policy in December. The International Monetary Fund issued a warning in March that China's local government debt alone had reached a record high of 66 trillion yuan, which is equal to half of the nation's GDP. Due to the reasons discussed in this video, China saw a significant drop in imports in April, down 7.9% from March, while exports increased 8.5%. For the first time in more than 2 years, factory gate deflation, the prices supplied by China's industrial wholesalers, grew in April, while consumer price inflation slowed to its worst pace in over 2 years. However, according to Steve Song, director of the China Institute at the School of Oriental and African Studies in London, China's economy is not about to implode, but it is not roaring back to the golden decade of the 2010s when it grew at a double-digit level. Unemployment. According to Fu Linghui, the representative for the Statistics Bureau and head of its Department of Comprehensive Statistics of the national economy, due to the impact of the pandemic, China's economic growth has averaged 4.5% for each of the last 3 years, and pressure on employment is rather large. The urban unemployment increased 0.1 percentage points from January to 5.6% in February. The report showed that the 18.1% unemployment rate for young people aged 16 to 24 remained continuously high. According to Beijing-based data firm Big One Lab, the total number of jobs listed on key recruitment platforms in China for the first 2 months of the year decreased by 23% compared to the same period in 2022. Global exports. The main engine of China's economy, exports, has experienced a significant slowdown. Major trading partners' demand has decreased as a result of rising prices and slower development in those economies, including the US. Moreover, Chinese analysts are worried about the pressure the international environment is putting on China's economy. countries experiencing high inflation may continue to tighten monetary policy, which will further restrain Chinese goods from entering their borders. Furthermore, geopolitics, unilateralism, and protectionism are on the increase in the international environment and will exert pressure on global economic growth in the not-too-distant future, thus further worsening Chinese position in international trade. Potential deflation scenario. China is currently dealing with a completely different issue than much of the Western world: potential price deflation, which could portend major economic turmoil in the future. Deflation is a reflection of the economy's fragility and lack of confidence. Deflation frequently results from low demand for goods and services and can have a variety of detrimental impacts. People may put off purchases if they perceive prices dropping because they will be able to purchase a house or a car at a lesser price the following week or month. However, deflation and decreased demand will cause a decrease in Chinese imports from the rest of the world. But it's kind of a two-pronged problem for the rest of the world. On the other hand, it will result in a slight increase in price stability or even a decrease in the cost of Chinese exports. That might help countries like US to encourage price stability while importing Chinese goods. China's real estate market is in trouble. Undoubtedly, the housing sector's unfavorable sentiments and weak real estate activity can hinder the growth of a country. Currently, up to 1/3 of China's GDP is made up of the property industry and other industries that support it. Home prices have fallen by more than 20% last year in dozens of locations despite China's efforts to support the real estate industry. Home buyers have been refusing to pay their mortgages on partially constructed buildings, and some aren't really sure that their houses will ever be finished. The decline in demand for new homes has decreased the requirements to import building materials. Things are getting worse due to climate change. The effects of extreme weather on China's economy are becoming more long-lasting. For instance, the province of Sichuan in the southwest and the city of Chongqing in the central belt had a severe heat wave and subsequent drought last year. Factories, including well-known producers like Tesla and iPhone maker Foxconn, were compelled to reduce their hours or close entirely. China's Statistics Bureau said in August that compared to the same period in 2021, profits in the iron and steel industry alone had decreased by more than 80%. Chinese tech giants are losing investors. A 2-year-long regulatory onslaught on China's tech titans isn't helping matters. Tencent and Alibaba both announced revenue drops last year, with Tencent's profits falling by 50% and Alibaba's net income falling by half. As a result, tens of thousands of young workers have lost their jobs, contributing to a job crisis in which 1 in every 5 people aged 16 to 24 is unemployed. In the long run, this could harm China's productivity and growth. Foreign investors are taking their money as state-owned enterprises, which appear to be gaining favor. Thus, foreign investors are sensing that China may not be as open to business as it once was. For instance, SoftBank of Japan withdrew a large sum of money from Alibaba, while Warren Buffett's Berkshire Hathaway is selling its interest in electric vehicle company BYD. Tencent has withdrawn more than $7 billion in investments in the second half of last year. Things are still on the right track for China. While Chinese exports will continue to suffer from falling Western demand, but there is still many reasons to be optimistic about the domestic economy, especially the demand that has been stifled for 3 years due to COVID lockdowns. Moreover, considering the seriousness of Chinese authorities to expand their economy, the IMF forecasts that over the next 5 years, China will continue to be the main driver of global economic growth, accounting for about 22.6% of overall growth compared to just 11.3% for the United States. To sum up this conversation, 2023 was supposed to be the year when China's economy, unshackled from the world's most stringent COVID regulations, roared back to help struggling global growth. Instead, it is facing a combination of issues half through 2023. Sluggish consumer spending, a crisis-ridden property market, faltering exports, record youth unemployment, and mounting local government debt. These issues are beginning to resonate over the world, affecting everything from commodity prices to equities markets. So, is China's economy doomed to crash, or will they be able to rebuild from hardships caused by the pandemic? Only time will tell. Thank you for tuning in. Don't forget to hit the like button and subscribe to stay updated on the world of economics. Until next time.